Hi everyone, Chris from Next Step Insurance here to talk about the tax credit calculations. In a previous video, I talked about the modified adjusted gross. That's the income the marketplace is looking for. And now I'm going to show you what that income is used for, the tax credits, to make it affordable for you to have insurance. Sometimes it may not seem affordable, but once I explain this to you, it might make more sense. So let me share my screen. So again, in case you haven't watched the previous videos, my name is Christina. I own an insurance company in Wisconsin. We have clients throughout the country. We started our company in 2020, but I've been part of the marketplace since 2013. I like the Affordable Care Act. I've seen it save lives and make things affordable for people. So I'm one of those weirdos. I like it. But let's get to that tax credit calculations. So again, in a previous video, I discussed what is it they're looking for. They're looking for the modified adjusted gross income. So that's your adjusted gross income, non-taxable Social Security, tax exempt interest. You can the excluded foreign income, meaning you don't pay taxes on it. That's the modified adjusted gross. So if you didn't see that, please watch that video. Once you've figured that out, the eligibility of the tax credit is based on household income for the year that's coming up. It's everyone in the household. There's no income brackets. That's a tax term for tax accountants. Oh, I don't want to make too much. I'll end up in the next income bracket. But on the marketplace, it's all percentages. So if you make more, you pay more. You make less, you pay less based on the percentage. The calculation that they come up with is they take the second cheapest silver plan in the county for your family, and they make it 8.5% of your income, roughly. So they add however little or as much income tax credits to make it 8.5% of your income. If the rate of the plan is going to cost you more than 8.5 of your modified adjusted gross, then you get a tax credit. Pretty simple. If the plan is already less than 8.5% of your modified adjusted gross income, you don't get a tax credit. So if you're making $1 million and the insurance is only $50 or $500, well, you're not going to get a tax credit because it's way less than 8.5. So it's still actually quite fair. Everybody's paying roughly the same percentage. So what does that look like? Just a thing to remember. Percentages make it fair, so everybody's paying roughly the same percentage, but it can be confusing. And percentage doesn't mean same dollar amount, right? Because again, if you make less money or more money, it's going to change the percentage. And I don't know about you, I wasn't necessarily a math genius and percentages were a little confusing, but I will try and help that confusion get a little less. Things to remember when it comes to the marketplace and your income. Your tax size family matters. So if you're a wonderful parent and you're letting your 30-year-old live with you, they're not a tax credit dependent. You don't have to include their income. But if they live with you, married children that are tax credit dependents or tax dependents, then you get a tax credit. Taxable income matters. If you don't have to tell the IRS about an income, I don't need to know about it. If you had a great financial advisor who advised you to put a lot of money in a Roth IRA, and now that's what you're living off of, great, it's not taxable income. So if the IRS needs to know about it, you've got to put it in your application. I'm going to show you an example of 3 couples that are 10 years apart, but making the exact same amount of money. So this couple in my area, ages 43 to 42. They make $45,000. So in the area of this where I live, they would get a tax credit of $670. The original cost of the bronze plan before the tax credit is $756. After it, $86. So this couple would only have to pay $86 for a bronze plan. The silver plan would cost around $162. A gold, $310. Same situation, but now the couple is 10 years older, so 53 and 52, making the same amount. But look at that tax credit. It's $1,099 a month. Their bronze plan will now be $47, and the cost of the silver will be $162. Did you notice that on the previous slide? They also are paying $162, roughly the same amount of income percentage. The tax credit, though, is quite different because when you're younger, the plans are cheaper. When you're older, the plans cost more, so you get a bigger tax credit to help make that silver plan 8.5. Well, now let's add 10 more years. So now this couple is 63 and 62, and the cost of their silver plan is 162, but the bronze plan's $1, and that gold plan 475. The youngest couple, it was only 310. So the more expensive plans, as you get older, the tax credit may not go as far with the gold plans, but the silvers are all roughly the same. So now I'm going to show you what happens if this couple makes $20,000 a month more, or $20,000 a month, $20,000 a year. So now they're making $65,000. So the tax credit is less. It's $1,336, where before their tax credit was $1,598. So you add again as much as they need to make that silver plan roughly 8.5. In this case, it's $424. So they are paying more than their neighbors across the street who only make $45,000, but they're also making more. So that 8.5% is the same. Again, if they made $85,000, it's going to be more expensive. Now it's $602 a month. But again, they're making $20,000 more. And the exciting thing, as I mentioned in a previous video, there's no more income cliff. In previous years, this couple wouldn't have had any tax credit. They would have had to pay the full cost, $1,700 a month for insurance. That's why it was very important that that income cliff not come back. And in my area, the rates are so expensive that even at $105,000 of the modified adjusted gross, this couple would get $1,000 tax credit. That's a savings of $12,000 in a year. It's pretty exciting. Now, you might be going, well, how come the insurance is so expensive? The cost of healthcare is very expensive. To me, that's the next thing they should be working on. Let's get the rates of that health insurance or the cost of healthcare down. But in the meantime, one of the things that happens is if there's a couple 63 and one turns 65 and goes on Medicare, the expectation is that their rate's going to go down because now it's only covering one person. But we're back to that percentage thing. So here we go. One couple age 63 and one turns 65 and goes on Medicare. Their income is still $65,000. But the cost of the bronze plan goes up from $343. The silver plan, $424. This is still a savings of over $5,000 in a year. So it's not like it's not worth anything. It's just not as big as it used to be. That's because the 65-year-old or 64-year-old, his plan was more expensive, or her plan. So there was a larger tax credit to make that silver plan 8.5. But now that there's only one person on the plan, the cost is significantly different. It's $424, whether it's one person on the plan. It's $424 if there's two people on the plan. See, percentages. So even if you're a single person, because your spouse went on Medicare and you're paying for that bronze plan that went up, it is still less than 8.5% of your income. There are usually bronze plans that will cost less than 8.5%, and the golds will typically cost more than 8.5%. Now, there's exceptions to the rules, because why isn't there? There always is. Sometimes there's bronze plans that are really expensive, and they may not even be worth looking at, especially if there's less expensive ones. And there's some areas where the gold plan is actually cheaper than the silver, but typically the bronze is less than 8.5 and the gold is more. And there's usually one other cheaper silver plan, because remember, the calculation is based on the second cheapest. So that means all the other silver plans are going to cost more. You may pay more than 8.5%, especially if there's a plan that you need for a different network. Maybe the cheapest silver plan doesn't cover your doctors, but the fifth cheapest silver plan does. So you may pay more than 8.5%, but this is just a generalization and an average. Now I want to talk about that baby tax credit. I'm using this as an example to help you remember, why does the income count for the entire year? You have to remember, this is the IRS. So when you have a baby born December 31st, do you get a different tax credit than the baby that was born January? No, you don't. It's exactly the same. This is the same when it comes to the income. So even if you're only on the marketplace for half the year, They still want to know your income for the full year, January 1st to December 31st. And you can say, well, I'm only going to be on it for a month. They don't prorate it. The IRS doesn't care when you make your money, right? Have you ever had to fill that in on your tax forms? When did this income come in? No, they just look at the whole year as a snapshot. So when you are looking at calculations for your income, when it comes to the marketplace, make sure you remember the baby tax credit. We need it for the whole year. Any questions? Put those in the comments and I will get back to you as soon as you can. Again, this is Chris from Next Step Insurance. We are the #1 health insurance company in Sheboygan County, Wisconsin. We are taking over the world. Please call, email, text us if you have questions. Thanks.